Hi, and welcome to JP Morgan's Making Sense. I'm your host, Brady Leventhal, head of North America Foreign Exchange Sales for Hedge Funds. Today, we are going to be discussing our recent global macro conference, where we had nearly 300 clients registered in our new headquarters in New York City. This is our 10th annual global macro conference that JP Morgan has hosted. With me today, I have Matthew Franklin Lyons, head of global rates trading and fixed income financing, and Stephen Jeffries, head of currencies and emerging markets and FX services trading. Welcome, Matt and Steve.
Hi, Brady. Thanks for having us.
So we were all on a panel together called Risk and Reward, live from the trading floor, where we tried to shed some light on our key risk views and opportunity sets for 2026. I made the joke on stage that people thought we were actually going to be live from the trading floor, so I guess this is sort of our second chance to do that. So anyway, our timing was great. We were emerging from the longest shutdown in U.S. government history. We've got a lot of data to come and definitely interesting questions on the Fed. So you both were kind enough to discuss your views on markets and opportunity sets on stage. I'd love to recap the highlights here today. So Matt, can you kick us off and discuss the main drivers in your market?
Sure. So this year is best summarized by examining either sides of the global yield curve steepener, which occurred across many currencies, but certainly dollar, euro, UK, Japan, call it between 50 and 100 bips front to back yield curve steepener. And I think beneath the surface, there's some quite intuitive things happening. In the front end, of course, central banks delivered cuts from moderately restrictive policy rates down closer to what they believe to be neutral. And then further out the curve, supply-demand mismatches and the shifting composition of the demand side for sovereign debt took different forms depending on the currency, but all kept long-end yields mostly unchanged or higher in yield. In the case of the US, of course, we have the much-discussed shifting composition of buyers towards the private side, towards price-sensitive hands, towards levered hands. And that's accompanied by really significant issuance, $2 trillion in net terms, which is relevant for financing, but then in gross terms, $3 trillion or more. And those numbers are all going up. In gross terms, they're going up from 2.5 to 3.5 and above that in the years ahead. But again, as I said, there's something occurring in similar form in each currency. So in euro, there's the Dutch pension story. In Japan, of course, there's a significant supply-demand mismatch in the long end, increasing issuance. So every currency has a question mark around fiscal sustainability at a time when there is a shifting composition of the buyers of sovereign debt. And we think the interactions of those are what's driving this global move to higher yields, which is playing out really as we speak. So you put all these together, and this is the sort of global yield curve steepener that we're seeing. Back end yields, belly yields higher, all while the front end is relatively well anchored due to central bank policy normalization. That's how we think about what happened this year, and that's the main factors which will continue to drive rates over the next year, and particularly focused on this question mark around fiscally driven increases in supply paired with an unhealthy shift in the supply-demand balance for the demand side of sovereign debt.
Thanks, Matt. And now, Steve, how are you framing your thought process for trading currencies?
Yeah, well, I think if you go back to where we were only a few weeks ago at the macro conference, I was portraying myself as being, relatively bullishly set up for certainly emerging markets and generally in FX across carry. I think if you looked at some of the returns, certainly from currencies, sort of talking high single digits in some high carry currencies across the globe, whether even if it's G10 or EM, carry had certainly played out in the second part of the year as we moved through the more volatile part of 2025 with the tariff situation. And as we calmed down, as the Fed were able to ease rates, then carry especially really blossomed in the emerging market situation. I think across EM fixed income, whether it's the Frontier or the more broad index, you're talking around, high sort of teens returns for the year, which is really definitely a return to flavor for these kind of markets. We hadn't seen inflows into EM local currency for the last, 5 or 6 years, and we started to see fund inflows this year, I think around $10 billion at the time of the conference, and I would imagine that would have ticked up since then. And that compares to around 45 billion that had flowed out in the years starting from the pandemic time. So, really a decent backdrop in terms of yield pickup, in terms of technicals, given where you are in terms of money put to sort of EM markets. So that sort of frames my thoughts then. And broadly, I would say that they are similar now. But what we've seen actually, interestingly, in the last few weeks, and this is not just EM phenomenon, and not to take Matt's thunder, we've seen a lot of repricing of front ends. And from an EM point of view, that's Korea, That's Colombia. India cut last week, but a bearish reaction. And, we're starting to see moves in the markets where yields are pushing higher. So I think there is a little bit of time to be cautious, but the outlook for next year where policy will remain easy, maybe not easing, but still relatively easy across the globe, and growth supportive, I think that will lend itself to being good for carry and EM in 2026.
Well, thank you guys. Actually, this sort of ties into my next question. So, the Global Macro Conference brought together hundreds of investors. Did you get a sense of investors' moods, or did anything surprise you during your conversations with clients? And I'm actually happy to throw one out there, and it sort of ties in with both what Steve and Matt have already talked about. So, I was actually surprised given how many unknowns that we have out there. So, Fed Chair, IEPA ruling, Cook case, et cetera. We're still waiting for the meat of the tier one data from the shutdown. The clients I've spoken to were relatively constructive risk. And as such, Steve, to your point, we're positioned in a long carry and low vol portfolio. And then on the other side of that, I did speak to a smaller subset of clients that did feel that there's material risk that the Fed may not be easing further in 2026 and that Fed terminal will ultimately need to be repriced higher. This is in conjunction with another takeaway from the conference that the administration is likely going to have to take on the cost of living as a major political issue. And we've already started to see some headlines coming from that. So just interesting to see if your conversations echoed that, or you heard some other interesting tidbits.
Sure, I'll happy to take that first. You summarized it well just now. There's a great deal of complacency around carry, particularly focused in asset swaps in fixed income as part of the rates focus. And then also, I found there to be a disconnect between aggregate positioning and discussions around policy rates, meaning the probability that global central banks were going to be able to cut significantly further relative to forward rates. Most were skeptical, but that wasn't reflected in their position. I'll be more specific. In the case of dollars, I think most were in agreement with our narrative that the market's pricing down to and below 3% was inconsistent with the data backdrop, inconsistent with the inflation backdrop. And yet most retained steepeners. Similarly, on asset swap, people thought that the global carry backdrop was a bit overextended, and yet many retained asset swap longs in the belly and front end across multiple currencies. So that is an overall theme. I felt that there was some disconnect between shifts in the underlying macro backdrop as it relates to carry, shifts in the underlying macro backdrop as it relates to duration in the belly, relative to aggregate positioning, which remains quite long and in steepeners.
Yeah, I think generally people, see this time of year looking for the year ahead trade, and generally what works next year is what's happened in the current year. And as I laid out, being in frontier EM, being a local currency EM or higher carry in the G10 FX space has worked. People were looking for continued opportunities of that. And, I think that anyone with an EM background always should have a certain amount of, cynicism around the market and always question what exactly is going on, what can go wrong. As I mentioned, positioning is certainly in an okay spot. It may be concentrated in some of the specialist hands, but I think that broad amount of crossover money that could come into EM is still able to move and can move into the new year. To echo Matthew's points around Fed policy, I think, that's the one thing that concerned me. I think at the time of the conference, we were still skeptical on December Fed cut. Obviously, that has been, who knows? That should be clarified in the next few days. And there's been a turnaround. But where we go forward, I think, is the big question. If the Fed can't cut to what's delivered, what's priced, then I think that's going to take some digestion from the market.
Yes, agreed. That was one point that we did bring up in the conference was sort of obviously we had the deck Fed and then sort of the and beyond. And it's the and beyond that I think is the big question mark for 2026. So, all right. So one question that we didn't get to on the panel was actually the final question I had, which was our lightning round. So risk versus reward. So what risks are you worried about that aren't so obvious, and what opportunities do you see for 2026? And remember, this was supposed to be our lightning round, so you can keep your answers brief. So Steve, do you want to kick us off?
Look, I think the credit markets are very interesting. The amount of supply that's going to come out of the AI boom, how that feeds into the other existing markets like sort of broad DM credit and then into EM. I think that, can the market take down that amount of issuance for the investment that's needed? That's a big question mark.
Great, thank you. You still see then carry and select EMs is where you want to be for 2026?
Look, I do. I think the fundamentals in EM remain extremely robust. You've had, a good number of elections in 2025 in LATAM that have trended towards the right the right wing and more market friendly. Obviously, we have the big one in Brazil in a year's time, which, sparked a little bit of volatility on Friday. And then, looking at the fiscal position of a lot of these EMs is dramatically different from the G10 space.
Fair enough. All right, Matt, your risk versus reward?
Yeah, I mean, all of our comments at the macro conference focused on asset swaps and belly valuations. Specifically, the asset swaps were too rich, collateral too rich, and belly valuations both too rich. And that reflects the entirety of this conversation around the changing supply-demand backdrop, together with the economic backdrop, together with the positioning backdrop, and valuations as an overlay. And all of that, to me, point to asset swaps in a vulnerable place, and then the landing zone of policy rates and reds, greens, blues, 5-year rate, all of that also in a vulnerable place.
Perfect. Well, that's a wrap. Thank you so much, Matt and Steve, again for your time and answers today. Thank you to our listeners for tuning in to another episode of Making Sense. If you like this conversation, don't miss our Global Research Outlook podcast, where our research analysts discuss what lies ahead for markets and the economy in 2026.
The views expressed in this podcast may not necessarily reflect the views of JPMorgan Chase & Co. and its affiliates, together JPMorgan, and do not constitute research or recommendation advice or an offer or a solicitation to buy or sell any security or financial instrument. They are not issued by JPMorgan's research department but are a solicitation under CFTC Rule 1.71. Reference products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JPMorgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. The FICC market structure publications, or to one, newsletters, mentioned in this podcast are available for JPMorgan clients. Please contact your JPMorgan sales representative should you wish to receive these. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures. Copyright 2025 JPMorgan Chase & Company. All rights reserved.